Yes, friends. Good evening, Sandra, Shalmi. Good evening, Kirti, Ganga. So, friends, welcome to the second session of the Inter FM mentoring plan that we have. So, friends, last week I couldn't take a session because there was a conflict of class that was happening and I didn't want any conflict happening over there. So, friends, until today, the assignments of topics that you had to cover was cost of capital, management of working capital, capital structure, leverages, and investment decisions. These were the 5 chapters that I had asked you to do by way of assignments. Have you all done it so far, friends? Shall we just check how many of you have actually done the assignments? Give me a minute. We have the assignment column here. 1 minute. Let me go and check. Here we have 5 assignments created, friends. Let us see how many of these assignments have been completed. The first one was cost of capital. Okay. Now look over here, friends. We had 143 students who enrolled for the mentoring program, but out of this 143, only 10 students have submitted the assignment. This is where the difference mainly comes, friends. My request to all of you is please submit all your assignments. Maybe you have some office work pressure or whatever it is. Until you do the assignments, you will not be an expert in the topic. And if you're not an expert in the topic, you will not be able to get very good marks in the upcoming examination. So hats off to all of you who have done the assignment. Hats off, Akshara. Great job. Anju, Aisha, Bhavna, Harsha, Irene Francis, Kavya, Mubina, Hashim, and Sandra. Great job. Keep it up, friends. Keep up this excellent energy of doing your assignments. Just like that, we have more assignments. We had working capital. This is submitted by only 7 students. Abdul Aziz and Bhavna, Harsha, Kavya, Sankirtana. Great job. Others, please, please, please go and submit these assignments at the earliest. All right, friends? Yes. Liana, you're unable to view it on the laptop. What exactly are you not able to view on the laptop? You mean the file? Yes, I had explained to you the other day that file might not be viewable on laptop. You have to download through an app, either a phone. Because of security reasons, they are not giving access in the laptop, friends. That is the issue that's coming over there. All right. Yes. So, friends, apart from this, we have already done one particular mock examination also here, which is as of now submitted by only 2 students. Kavya has submitted. Sandra has also submitted. I will be coming live next week to discuss these mock test papers also. Right now, today's objective is to control and monitor as to where you have reached and what more we need to do. So, friends, by next week, we have to complete investment decisions also. We have to complete financial analysis also. And we have to complete theory part can be done the week after that. But if we cover ratio analysis and investment decisions by next week, we are very close to the examination also. At the same time, we will be having a very good grip on the major part, which is scoring from an examination point of view. So if you take up this entire area, this entire thing has to be completed by next week without fail. Once you do this without fail, trust me, you will have such good grip from the examination perspective that you will be able to score very good marks in the upcoming examination, friends. So I request you all, please do not delay. Please go and do these assignments thoroughly. Whatever doubts you have, WhatsApp me. I will be there to clear all your doubts and we can take it forward positively, friends. All right? Yes. Now comes the doubt clarifying session, friends. If you have any doubts, please do ask me these doubts so that I can clear these doubts for all of you. Yes, friends. Any doubts, you can unmute and speak to me, or you can just send me a message and you can also ask me doubts live over here. So whatever is your doubts, I will clarify those doubts. After that, I will be giving you a concept revision on this chapter today, that is ratio analysis. Okay. With that, we'll be packing up today's session. All right, friends. I believe as of now, you don't have much doubts in your mind. Well and good. Whenever you get doubts, you can note down my number. You can WhatsApp me on my number and I will be there to clear your doubts, maybe within 2 or 3 days of time. All right. Yes. Fine, friends. So now let me just give you a plan about today. I'll be covering ratio analysis chapter for you, which is pending from my side to be done. I have already done a 90-minute workshop on other topics. I'll just show you where you can always view and take these things from my application, friends. Hold on. Yes, I'll just show you. We have a Inter FM 90 minutes workshop here. Yes, this one. One moment. Yes. CA Inter 90-minute workshop. So here I'm doing a chapter-wise revision and we have done 5 contents so far. Okay. First, we have told about the mentoring program. Down, if you see, I've done dividend policy chapter. We have also done cost of capital. And session 3 we have done is about working capital management. Today, I'm going to do session number 4, which is called as ratio analysis. Okay. Friends, I'll just explain to you the logic of ratio analysis. When we speak about ratios, according to me, you have the following 5 types of ratios from the examination perspective. The first one are the ratios which are expressed in percentage. Second one is the ratios expressed on a per rupee. Third one is where it is coming per share. Fourth one, it is going to be ratios which are similar to turnover ratios. Fifth one is what we call it as inventory holding period or velocity. Holding period or velocity. Last one, you have something called as coverage ratios. These are in nutshell the 6 types of ratios that you have in your Inter FM syllabus. Let me explain to you these one by one. So part number 1 are the ratios which are mentioned in percentage. For example, if you speak about GP ratio, what is the formula for GP ratio? Gross profit divided by sales. So your GP might be 5, sales might be 100. Do you get the answer as 5%? Or the logic is for every 100 rupees of sale, my GP turns out to be, how much rupees, friends? It turns out to be 5 rupees. Is everybody clear with this part now? Fantastic. Same way, I can give you one more ratio now. Let us say we are talking about ROCE, return on capital employed. The formula would be EBIT divided by whatever is your capital employed. So let us say your EBIT is turning out to be 20 crore. Capital employed is 50 crore. Do you get the answer as 40% over here? The logic of this 40% is that for every 100 rupees of capital employed, EBIT is how much rupees over here, friends? 40 rupees. Is everybody clear with the logic? So whatever comes in percentage, everything will have the same logic. For every 100 rupees, this is the answer. For every 100 rupees, this is the answer. I'll give you 1 minute. Go through this and understand this part. All right. Can I go to the next part now? Fine. Second type of ratios are what we call it as a per rupee ratios. Okay. So here, for example, per rupee ratios, we can have the first ratio as, let us say, current ratio. Everyone tell me what is the formula for current ratio? It's a very simple formula, that is current assets divided by what? Current liability. So let us say you have 150 crore of current assets and you have 100 crore of current liability. You will get the answer as how much? 1.5 times. Or the logic of this 1.5 times is for every 1 rupee of current liability, I have 1.5 rupees of what? Current asset. I can give you one more example. Let us say we are talking about debt ratio. That will be nothing but debt divided by total assets. So let us say your debt is turning out to be 80. Total assets is turning out to be 100. Do you get the answer as 0.8? Or the logic is for every 1 rupee of total asset, my debt is how much? 0.8. I'll give you 1 minute, read and understand this part. Then I will go to the next type of ratios. All right, friends. Are you all clear with this part now? Can I go to the next one? Okay. Next one. Per share ratios is done. Sorry, per rupee ratios is done. The third type of ratios is what we call it as per share ratios. These are very easy. For example, EPS. What is the formula for EPS? Total earnings divided by what? Divided by number of shares. So let us say your total earnings is turning out to be 5 lakh and you have 50,000 shares. You will get the answer as 10 rupees per share. Or the logic is for every 1 share, my earnings is how much rupees? 10 rupees per share. Okay. That is how we analyze the ratios of per share ratios. So friends, we have learned how to understand ratios in percentage, how to understand ratios in rupees, how to understand ratios on per share basis. Next is what we call it as the turnover ratio and holding period. I will show you these two together because both are interconnected. Let me take two companies, particulars. Suppose you have A and then you have B. Let us say the cost of goods sold of A is 100 crore, of B is 80 crore. Average stock of A is 25 crore and B is turning out to be, let us say, 20 crore. So when I find out the stock turnover ratio, the formula would be A divided by B, or I will get the answer as 4 times for the first one. So, okay, second one, friends, I'll change the number here. Let me put it as, let me put it as 16 crore. So do I get the answer as 5 times over here? So what this means is that stock A is rotating 4 times to achieve the turnover, whereas stock B is rotating 5 times to achieve the turnover. So which is better, friends? B is better because it has a better rotation of stock. It's able to move. So B has, the logic is B has fast moving goods. B has fast moving goods. All right. Here only what I will do is I will now find out the inventory holding days. Inventory holding days can be found out using two methods. Formula number one, I can do 365 divided by stock turnover ratio. So now tell me, how much is 365 divided by 4, friends? Can you tell me? I think it will be, I'll need your help on that. Can you please help me out, friends? How much is 365 divided by 4? 73, 146. Did I get that correct? 91.25. Thank you so much. So here you get the answer as 91.25 days. And what is 365 divided by 5? Can you tell me? I think you will get the answer as 73 days, correct? This answer can be found out either by doing 365 divided by stock turnover. This is option number 1 that we can use. Or we can use option number 2, that is 25 crore stock divided by 100 crore total cost of goods sold into 365. Here it will be 16 divided by 80 into 365. Are you all clear with this part now? So both these ways, you will be able to find out this answer. Or the logic is, in company A, since the stock turn ratio is less, stock turn ratio is only 4 times, their inventory holding will be only how many days, friends? Inventory holding will be only 91 days. So the stock is blocked there for how many days? 91 days. Whereas in company B, stock turn ratio is 5 times and the inventory will be blocked over there for how many days, friends? It will be blocked over there for 73 days. I'll give you 1 minute. Understand this part also. All right, friends. So we are clear with the concept of stock turn ratio also. We are clear with the concept of holding period, stock holding period also over here. Now, friends, we have a final concept that we have to learn over here, which is the coverage ratio. Okay, so I'll give you one example over here, that is interest coverage ratio. Friends, the formula for interest coverage ratio is EBIT divided by interest. So let us say your earnings before interest and tax is 100 crore. You have an interest of 20 crore, means you will get the answer as 5 times. This is, let us say, company A. Let's talk about company B now. In company B, when I do the same thing, let us say they have 200 crore of earnings, but they have interest of around 100 crore. So do you get the answer as 2 times? Which one is better, A or B? A is better because A is earning 5 times more than the interest. It is very secured. B is earning only 2 times more than the interest. It is having high amount of risk. Everybody clear? So what is the logic over here? Higher the ratio, the better for the company. Okay. Can you write down this in your books now? All right, friends. So these are the different types of ratios that you will encounter in your study material. Now, can I take the study material and just check it together, friends? All right. When I take this chapter, friends, you don't have to read through the whole chapter. You have the summary ratios given over here. These ratios, once you go through it and study these ratios. So first one, if you observe, it is current ratio. It is turning out to be a per rupee ratio. For every 1 rupee of current liability, I will have this much amount of current assets. Quick ratio is also nothing but a per rupee ratio. For every 1 rupee of current liability, I will be having this much of quick assets. Everybody clear? Cash ratio also. For every 1 rupee of current liability, I will be having the following cash balance. Then we have a ratio called as basic defense interval ratio. Okay. This is basically, I'll explain to you with the help of an example. Cash bank balance. So let me put over here point number A, cash balance. Suppose your company has a cash balance of 1 lakh rupees. Okay. They have operating expense per day. Daily, they are having 1,000 rupees expenditure every day. All right. So when I divide by this, what is the answer I get over here? Do I get the answer as 100 days? Okay. This is what they call it as defense interval ratio. Or what is the logic of this? The logic of this is that if I spend 1,000 rupees per day in 100 days, my cash balance will become 0. This is one of the unique ratios, unlike the other ratios that we have learned. Everybody clear with this part now? All right. Can I go back? So that is your basic defense interval ratio. Then you have net working capital, a very simple ratio, current assets minus current liability. Equity ratio is a percentage driven ratio. For every 100 rupees of net assets, my equity will be this much. For every 100 rupees of net assets, my debt will be this much. For every 100 rupees of shareholders equity, my total debt will be this much. 1 minute, friends. Yes, friends. Shall we continue now? 4. Next one, debt to total asset ratio. So that is again in percentage. For every 100 rupees of assets, how much is going to be your debt? For every 1 rupee of your equity and reserve, how much is going to be your debt? Capital gearing ratio. For every 100 rupees of assets, what is your proprietary fund? Now comes the coverage ratios. Okay. How much time will your earnings cover the interest and installments? How much times your EBIT will cover your interest? How much times your profit will cover your preference dividend liability? How much times your EBIT will cover the interest and repayment of loan? Then we have turnover ratios. How many times will your asset turn to touch the cost of goods sold? How many times your asset will turn to touch your sales? How many times will your net assets turn to touch your sales? How many times will your working capital turn to touch your sales? How many times will your average inventory turn to touch your sales? Then you have how many times your debtors will turn to touch your sales. How much then they are asking about velocity. Debtors holding period, friends. The given one formula here, but I've taught you a very easy formula. You can do it using the formula I told you, 365 divided by debtors turnover ratio. You will get the same answer. Payable turnover ratio will be 365 divided by creditors turnover ratio. Everybody clear with this part? Okay. Down. Payable velocity is again the same thing. It is average accounts payable divided by average daily credit purchases. Friends, that and this is actually the same. Turnover ratio is found here. Holding period is what is found over here. Holding period, same logic what I gave you. 365 divided by creditors turnover ratio. Then you have GP ratio. How for every 100 rupees of sales, what is going to be your gross profit? For every 100 rupees of sales, what will be your net profit? For every 100 rupees of sales, what will be your operating profit? For every 100 rupees of sale, what will be your operating expense? For every 100 rupees of sale, how much will be your cost of goods sold and operating expense? For every 100 rupees of sales, how much will be your financial expense? Then we are again going to ROI percentage based. For every 100 rupees of investments, what is your return? For every 100 rupees of assets, what is your net profit? For every 100 rupees of capital employed, what is your EBIT? For every 100 rupees of capital employed, again, what's your EBIT? For every 100 rupees of your net worth, how much is your profit after preference dividend? EPS, DPS, payout ratio, all this we have learned, friends. Dividend payout ratio is DPS divided by EPS. It is how much percentage for every 100 rupees of EPS, how much of dividend has been paid. Okay. Then P ratio is again a turnover ratio for how many times the EPS will turn to go and touch the market price. Dividend yield, we have learned, friends, DPS divided by MPS. It's again based on percentage. For every 100 rupees of MPS, how much will be your DPS? For every 100 rupees of MPS, what will be your EPS? For every 1 rupee of book value per share, how much is going to be your market value per share? For every 1 rupee of your replacement cost, what is your market value? Friends, these are the logics. So I have just explained the logic of all the formulas and they are the same. Once you learn these 5 categories, that is percentage ratio, per rupee ratio, per share ratio, turnover ratio, coverage ratio, they are exactly the same except for defense interval ratio, friends. So my request to all of you is write down these headings in a piece of paper. Without looking at the formula, try recalling the formula from your mind. Initially, you will not get the answer. No problem. Keep trying until you get the answer, friends. Keep trying. Do it today. You don't get it, rest. Do it tomorrow again rest. Like this, in 3 or 4 days of time, you will be able to remember the entire formulas of this textbook, friends. That's my assurance to you. Okay. So let's pack up my session with this. Do you have any other doubts or anything else to clarify? No. All right. Friends, I'll just announce my next mentoring. Today is Tuesday, right? Next mentoring will be next Tuesday. So next Tuesday, what we will do is by that time, please complete your assignments. Today, my team will send you a message. Okay. Who all haven't completed the assignments, all of you will be getting a message. By next week, we'll be discussing the mock test paper also, friends. All right. So please write the mock test and make sure that you are strong in the subject. I'll see you next week, Tuesday. Have a lovely time ahead, friends. Take care. Thank you so much for your patient listening. Thanks a lot.